Okay, let's have a look at this then. First part of the question, define audit risk and define the components of audit risk. Fairly straightforward. We should know this. We should know that the audit risk as a whole is the risk that you're going to give the wrong or the inappropriate opinion when the financial statements are actually materially misstated. Okay, and it's basically made up of two components: the risk of material misstatement and also detection risk. Okay, but let's have a look at the three. There's inherent risk, there's control risk, and there's detection risk. They're the components of audit risk. Inherent risk that's just looking at how a transaction or a balance, because you've got to think income statement or SFP. So how a transaction or a balance could be materially misstated before any internal controls. Okay, and that often happens when it's a quick change in business, when things are based on targets, so they're more likely to be manipulated. It could be because it's a cash-based business, but basically it's the risk of material misstatement before internal controls. Now, control risk is the risk that something's wrong on your income statement or something's wrong on your SFP, either individually or aggregated together, which would not be detected or which would not be prevented, detected, or corrected by internal controls. They wouldn't be. The risk that wouldn't happen. And then detection risk is the only one that's under our control, under the auditor's control. So detection risk is the risk that the auditor or the auditor's procedures does not reduce audit risk to an acceptably low level. Okay. And miss some material misstatements. And basically it's caused by sampling and non-sampling risk. I've gone into far more detail there than is actually needed. But anyway, you should know that relatively well. It's only 4 marks, as I say, it's more detail than needed. But yeah, so that's part A done.